Once you've made a pass through the income statement, it's time to move over to the balance sheet and get some insight into how well the firm is managing its operating assets, the investments it's made to generate sales and net income. We'll start with a big picture perspective by calculating the asset turnover ratio by dividing net sales by total assets. This ratio relates sales to the overall investment made to support and generate those sales. It tells us how efficiently NEBCO generates sales given its investment in total assets. An asset turnover of 1.6 means that for every dollar NEBCO invests in assets, it's able to generate $1.60 in sales. Clearly, a higher number is better. The asset turnover ratio, like all ratios, is only meaningful if the underlying financial statements properly capture all of the asset and liabilities, revenues and expenses that the firm incurs or has at its disposal. For service firms or firms that rely primarily on their human capital to generate revenue, their reported assets significantly understate their real assets, since the firm's workforce and its intellectual capital is not recorded on the balance sheet. In these cases, the asset turnover ratio becomes less useful. One approach to solving this problem is to substitute the number of employees for total assets in any ratio that makes use of assets. In this case, the asset turnover ratio would become a sales per employee metric, which can be a useful metric when analyzing service companies. While the asset turnover ratio is a good high-level metric, it's important to zero in on some of the more important individual assets. For firms that require heavy investment in fixed asset, the fixed asset turnover is a useful metric, calculated by dividing sales by net property, plant, and equipment. Similar to the asset turnover ratio, it relates the investment in fixed assets to the amount of sales generated. The fixed asset turnover ratio is most useful when analyzing companies that rely on significant investments in fixed assets to run their business. And like the asset turnover, a higher number is better, indicating the company is generating more sales for each dollar invested in fixed assets. Some of the most interesting asset management ratios are the working capital ratios. I say that because these three ratios can have a huge impact on a firm's cash flow position. They focus on inventories, accounts receivable, and accounts payable. Each of these ratios can be computed as either a turnover ratio or as a days ratio. They provide exactly the same information. I prefer the days version because I think it's easier for most of us to think about inventories, receivables, and payables in terms of the days it takes to collect on our receivables or the days it takes to pay our suppliers. But since we're having so much fun, I'll calculate the ratios both ways for New England Boat Company. Let's look at the inventory ratio first. The inventory turnover ratio is calculated by dividing cost of goods sold by inventory. This tells us how many times our inventory turned over or was sold during the year. The higher the turnover ratio, the faster we are selling our inventory, which is a good thing. For NEBCO, the inventory turnover ratio is 6, computed by dividing cost of goods sold, $2,100,000, by inventory of $350,000. Well, since we've already computed the inventory turnover ratio, the easiest way to compute days in inventory is just to divide 365, the number of days in a year, by the inventory turnover ratio. If inventory turns over 6 times per year, that equates to every 61 days. This tells us that NEBCO has about 61 days worth of inventory on hand, or put another way, it takes NEBCO on average 61 days to sell its inventory of boats. Once the inventory is sold, the next question is, how long does it take NEBCO to collect the cash? Let's turn to the receivables turnover and days in accounts receivable ratios to answer that question. The accounts receivable turnover ratio is calculated by dividing sales by accounts receivable. This tells us how many times our receivables turned over or were collected during the year. The higher the turnover ratio, the faster we're collecting on our receivables and credit sales, which is good since we need the cash. Sooner the better. For NEBCO, the receivables turnover ratio is 6.9, computed by dividing sales of $3,100,000 by accounts receivable of $450,000. To convert this to days in receivables, we can do the same thing we did with inventory turnover. Divide 365 by the accounts receivable turnover ratio to get 53 days. This means that it takes NEBCO, on average, 53 days to collect the cash from a customer once they sell a boat. While that may seem a bit long, remember what we heard from NEBCO's management. Many customers were holding off making final payments because the boats weren't completely finished, something they'll have to fix in the future. Put this together with the days in inventory, and we see that it takes 61 days for NEBCO to sell a boat and another 53 days to collect the cash. So NEBCO is out of cash for 114 days, almost 4 months. That's a lot for any company, but particularly for a startup that needs every dollar it can get. Being out of cash for 4 months means NEBCO needs to get this cash from somewhere else, borrow it or sell stock, or it could delay paying its vendors as long as possible. If that's the case, NEBCO would like to ask its suppliers to wait 114 days to get paid until NEBCO has had time to sell a boat and collect from its customer, but of course suppliers don't want to wait that long. Well, how long does it take NEBCO to pay its customers? Let's look at its payables turnover and days in payables ratios. The accounts payable turnover ratio is calculated by dividing cost of goods sold by accounts payable. This tells us how many times our payables turned over or were paid during the year. For NEBCO, the payables turnover ratio is 7, computed by dividing cost of goods sold of $2,100,000 by accounts payable of $300,000. The higher the turnover ratio, the faster we're paying our bills to our suppliers, which is a good thing for our suppliers, but uses up our cash. This is the challenge for any company, but particularly for startups. They want to conserve cash by taking as long as possible to pay their bills, but then they also want to maintain good relationships with their suppliers by paying their bills on time. This is just one of the many delicate trade-offs the successful entrepreneur must figure out. Putting this all together gives us what's referred to as the cash operating cycle or the cash conversion cycle. Basically, it's the length of time the firm is out of cash due to the time it takes to sell inventory and collect cash, and the fact that vendors want to be paid sooner rather than later. Clearly, firms would like to have their cash operating cycle be as low as possible, meaning they're out of cash for a shorter period of time and don't have to rely as much on other sources of financing to finance their working capital. Firms that can effectively manage these ratios can save themselves significant amounts of cash. How do you do this? Well, for one, you may work with your suppliers to convert them to more of a just-in-time supplier so you can reduce their investment in inventories without risking stockouts to your customers. Or you might work more closely with your customers to see what it would take to get them to pay more quickly, or maybe even in advance for some of their purchases. You can all probably think of things you do in your businesses to accelerate the conversion of cash by working with your customers and suppliers. And for the entrepreneur managing their startup or a growing company, this can be one of their most significant challenges. Maintaining an appropriate balance between investing in an inventory, paying your suppliers on time, and collecting from your customers as quickly as possible. For many young firms, this can mean the difference between success and failure.